This trader just made $28,562 trading the S&P 500. But what most people don't realize is that this strategy looks great on the surface, but there's a hidden risk that could damage your account if you don't see it coming. Today, we're going to review this video from Carmine. We'll discuss what worked, what didn't, and most importantly, what you need to know before even thinking about trading this way.
Today on the S&P 500, I made a gross profit of $16,000. And so far this week, I'm up 30K. And I really want to go over some specific trades so you could see some of my mistakes.
Now, one note, look at his win rate is 50%. A lot of traders mistakenly think that in order to make money like this trading, you need to have like a 70 or 80% win rate. And they brag about their win rate, or they really focus on trying to get their win rate up. But look at this, 50% win rate. You can see it right there on the screen, 50%. That means his odds of winning a trade are like a coin toss, no better than that. So how is it that you get a 50% win rate and you make this kind of money, $28,562 on one trade with a net P&L of 67 grand? Risk to reward. The answer is risk to reward ratio. And if you are good at trading, if your trading strategy is effective, and if you are effective at executing trades, then you have a positive number here. Do you see this number that says average win or loss? Okay, that means if he risks $100, he's likely to make 300 or more. Now, you tell me, if I was going to give you $300 every time that you gave me 100, how often would you make that trade? Knowing that you only win every other time, 50-50, you make that trade all day long. So forget about win rate alone because it tells you absolutely nothing useful. What you want to do is take the win rate and then combine it with your average profit per trade, which is this average win-loss that you see right here. That's how you know the actual results. So if you're a beginner trader, you want to start to get more sophisticated in your understanding of how you analyze traders' wins and losses. And I want to share with you how I analyze my own wins and losses. And it's called the execution quality score. What you need to understand is that execution matters just as much as your strategy, because you have to be just as good at executing your strategy. Otherwise, the strategy doesn't matter. So I actually score my execution, and I use this execution quality score to do it. And it involves four things. One, my preparation. I score each of these out of 25. So how many points out of 25 is your preparation for that trading session? Two, I look at my mental game management. So how am I managing my mind and emotions? Did I succumb to FOMO? Did I let a loss derail my piece? Scoring that out of 25 points. And then execution, which is very simply, was your entry according to your rules and procedures? And how about your stop loss and your profit target? And then did you set it and forget it and let it ride? Or did you mess with it? Did you follow your rules or not? That's essentially your execution score. I score that out of 25. And then P&L is one of these four things. And combine all of these together, that gives me out of 100 points, my EQS or execution quality score. And you're welcome to borrow this from me or develop your own way of scoring your execution. But the point here is that you need to actually analyze. Otherwise, you're missing a critically important, absolutely essential factor.
Mistakes and things that I've messed up on. And you can see some of my really good trades. That way you can learn something from it and implement it in your own trading. But before
all right, so let's get into it. I've got the whole strategy mapped out here. And my goal for you with this video is to help you take the best parts of Carmine's strategy while avoiding the biggest pitfall so that you can trade with more confidence and consistency. How about that? Let's get into it.
But now let's get right into the breakdowns. To understand the setups on March 13th, which was Thursday, we have to go over the pre-market plan. I post these every single day in the Discord of the setups that I'm watching and levels that I'm looking out for. The main thing that I was really observing for, and scenario number 3 was the scenario that came into effect, was the market was relatively balancing out, and we had a support level at 55.53. So my idea, my thesis was the past 3 sessions, the market hits it, bounces, sells off, hits it, bounces, sells off, hits it, and then bounces again. And even now in the overnight session, we're doing the same thing.
Now, another thing I want to point out, people draw support and resistance lines. What you see right here is a support line. What you see right here is a support line. But what I want to key you into is that these lines need to be drawn as ranges. Areas, if you will. Because look, if you drew this line and you thought that support was right here, and you can see that this candle here broke that support, or this candle here broke that support here, you would think that now support turns into resistance and you might be tempted to get short all the way down here, but that would be a mistake. So instead of thinking of these as lines, think of these as areas of interest. And what are support and resistance areas? They're like magnets. So it doesn't tell you that the price is either going to go down or up in that area. What it tells you is to pay attention to what happens to that area and then watch how the price reacts to that area. That's the appropriate way to use support and resistance as an area that is an area of interest, that's a magnet. Then you watch how the price reacts and then you make your decision.
So my thesis was if the level of support breaks to the downside, yet the market holds it, it could be a good indication of a failed breakdown of balance. And this typically is a very bullish indication. So now the market opens up, and pretty much directly after the open, we see a significant sell-off to the downside. And I'm going to stop this around 9.
So you have a double top here, right? Because the market went up and then it went up to almost that same point, and now you have a double top. You see that here and here, two tops. And then what happened? We moved down, okay? And then look what happened here. We came back up to test near that area, and then the price rejected down. That's why you can see this has a big wick on the top, or a big tail, okay? And then we had a bear bar and then another bear bar, okay? So a strong bear breakout after a retest of that high. Now you have all of the requirements for a possible major trend reversal. And my rule, as you know, if you see my channel, is compliments of Al Brooks. Never trade against a strong trend until you get one, a break of the trend line. So if the trend uptrend was here, okay, the break of the trend line would be here, all right? Because if we connect this low to this low, that line would extend out to about here. So there you have a break of the trend line. Never trade against a strong trend until you get one, a break of the trend line, and two, a retest of that extreme high. So now the two criteria are met because we have a break of the trend line here, boom, and two, we have a retest of that high here, here, and then another one here, okay? And then a breakout for the bear showing strong momentum to the downside. So as far as I'm concerned, once this candle, this bear bar closes on its low, now we have appropriate confirmation to go lower. But let's see what his strategy tells him about where to enter.
56, because after this significant drop into this level of support that I just mentioned, the market keeps bouncing off of, there's some significant volume activity that we have to be aware of. So pulling up the book map, I have a full order flow series on my YouTube. If any of this order flow terminology confuses you, I would really recommend watching the order flow series on my channel. But as the market was aggressively selling off, zooming out, we could see a lot of red bubbles, which just indicates a lot of selling pressure or trades hitting the bid as the market's moving down. But zooming in, there was some significant activity at 55.70 that I want to highlight here. And this is what I call a zero print, or basically no volume being transacted on one side of the market. As we can see here, the market aggressively moved down, large selling volume. And now that I look at it, the market rejected this pretty well 2 different times. But what's significant here is at 55.71 and 55.70.75, there is zero volume which traded on the offer. I've made so many recap videos, I've taken so many trades off of this, that these levels are magnetic forces where the market likes to gravitate towards.
Now, why would that be good? Why would you want there to be no volume being conducted? That sounds like it'd be a bad thing, right? No, it's good because it hints that there are trapped, okay? There are trapped either buyers or sellers. So what you want in order for a big move is you want one side to get trapped, because that's how you get a big move. When you get traders that are trapped, either longs or shorts, they have to panic out of their position, accepting the fact that they are wrong and essentially giving up. And what they do is they exit out, and then the opposite side takes the same position they do, and that causes a push either up or down.
So pulling up a normal candlestick chart, I'm just going to mark the 55.71 level, and I'm going to put this as a blue line. These levels the market likes to trade at because at the formation of it, the market did not give a fair opportunity to trade at that price. So as the market is selling off, I developed this thesis that I am watching for a break under the pre-market low.
Okay, so he had a bottom here. You can see that. And there's another bottom here and another bottom here. And he drew this area as a support area, right? So he's just betting that most likely, and I'm pretty sure he's going to get to taking a long here. Okay. So the thesis, as far as we can tell so far, is betting that there's going to be buying where there was buying before. Does that sound reasonable to you? Yeah, I think so. Okay. So breaking down his strategy on trade one, he's about to tell us how he hesitated and how traders can avoid missing out. So let's look at why he hesitated and then see what we can learn from it.
The market is selling off, I developed this thesis that I am watching for a break under the pre-market low at 55.59, which I've now highlighted as this yellow line. If this yellow line 55.59 can break and hold above that 55.53 level of support, again, that I mentioned in the pre-market plan, if we can break pre-market low, yet hold that level of support at the 53s, I am interested in playing long, targeting that 55.70 level that I just mentioned.
So the first thing I want to point out here is that he knows what invalidates his trade idea. This is a question for you. If you're here to learn something and not just be entertained, then consider this question. When you enter a trade and you develop an idea of what you think is going to happen, up or down, do you also include what would invalidate that trade idea? Most traders do not. And if you are not doing that currently, taking that and implementing that into your trading right now will immediately make you more effective in your trading strategy. What is an evidence that would invalidate your trade idea?
These levels are like magnetic forces. The market likes filling them and likes trading at them. So my thesis most of the time is looking to get long or short targeting that level. In this example, the market was selling off, breaking a pre-market low. And then eventually we hit that 55.71 level and it worked out perfectly. Now in real time, I did not find confirmation to take the market long. It happened relatively fast. I wasn't comfortable with what I was seeing down here at the lows. And in hindsight, it makes sense right now that I should have followed my plan and longed it. But in real time, I honestly just missed this setup, although it worked out perfectly. It sucks. It's not a big deal if we just sit back and focus on another opportunity.
Okay, so two things. One thing he did well, you could see, and one thing he did not. The first thing is that he had his plan, but then he hesitated. That's not good, right? When you see your setup and it meets your criteria, as long as you've been clear on your criteria, you enter. Okay, you don't ask questions, you don't get scared, you don't succumb to fear. Trading's kind of scary. It's like driving a race car, right? You just have to go for it, okay? When the setup's there. However, what he did well is he shook it off. Shook it off, shook it off, shook it off. Now, what most beginner traders are bad at is shaking it off, because they'll get in their heads and they'll spiral down and they'll start making themselves wrong, and then they'll get really angry and then they'll get mad at themselves, and it will cause a negative balance in their trading account. He did not succumb to that. What he did is he shook it off, which is awesome. So what we want to do is learn from that. And when we're trading and we miss an opportunity, shake it off and just move on to the next trade. That's all there is to do. If you miss something or you screw something up, you let it go and you move on to the next trade. That's it.
That was a good indication that buyers were present at the low. And again, these levels are so important to watch and mark. Now the market begins to rally, and on this rally, something else significant happens that indicates buyers are present here. When I show you the trades that I took yesterday, because it was a really good long position, which I'm going to recap after this one, this confirmation right here is very similar. It's what I call market structure demand. The market sells off, consolidates, and then rallies back up. And then I look to long a pullback into the area where it consolidated. And this was transacted right here at 55.65, which is where this basing or consolidation period came. So my plan here at 10:05 was to watch for a pullback into 55.65. If it could hold, I would then look to play longs. Now, 3 minutes after this forms, the market pulls back into 55.65. If I were to zoom in right here, it pulls back into 55.65 perfectly on this red little sell-off down here. And what it looks like off the tape is here's this market structure. Zooming in, the market pulls back into this 55.65 level pretty much perfectly, and then rallies up, and we get the continuation up. Now at this point, it happened again so fast. On this pullback, in hindsight, was a great opportunity, but honestly, I did not catch this long, and it was pretty frustrating that two of my bullish plans here have just worked out. Buyers are present in the market, and I was not able to capitalize on it. Now, the third thing is really what validated this and sealed the deal for me to capitalize on this long. So after just recapping this so far, after the buying that we saw at the lows under the pre-market low, after the buying that we saw at the 65s, we get the same exact thing that really occurs here at 55.80. You see this period after the market moves up, we consolidate, and then we get a rally to the upside even more. This consolidation to me is something that just piques my interest. It just indicates that the market is accepting higher prices. Now, after this trade works out, I'll just show you all basically what I was saying was the first move that I missed, it worked out perfectly. It was too slow to click the buy button. Same thing with the second move. And then the third one, which is this.
Okay, so he missed twice, right? He missed twice. Now let's see how he reacted to missing the move once and missing the move the second time.
Period of consolidation eventually does work out. Because I missed those other two trades, yes, in when I was experiencing that, it sucked. But because I spotted those buyers on the two other times, it just made this third trade even sweeter to me. That indicated that really buyers were very present on the intraday move. So it's all about perspective. Yes, I missed the first two moves, but since I did miss them, it kind of validated that the buying that I'm seeing at higher prices is very strong.
In other words, his analysis is still valid, right? So he was able to analyze the direction of the market. And just because he missed the trade idea doesn't mean that his analysis is no longer valid. He's actually going to use the same trade idea to enter the trade, even though he missed his initial 1, 2. I don't know if you saw it there, but 3 times he missed his entries. Okay. So, but it was all good, right? He's just saying, listen to how he sees this, because what you need to pay attention to is the trading strategy, but just as much, you need to pay attention to how these traders manage their mind and emotions. And what he is seeing is opportunity. He's just seeing the opportunity. He's like, oh, this is even sweeter, which is the mark of someone who has clearly developed some mastery around managing their mind and emotions, because he's not getting down on himself, which is what most beginner traders do, and something I certainly have struggled with myself. But when you do that, it doesn't help your trading, and the chart knows nothing about your feelings.
So as here, the market pulls back into this 55.80 level. It pulls back into it, and I'm comfortable getting long. This is also a low volume node. If any of you have watched one of my most recent videos.
Okay, so this is his low volume node, which is he's using to enter that trade. So you can see that he hesitated, and traders can avoid missing out. You can avoid missing out by just executing when the setup is there, okay? Do not think when the setup is there. You define your criteria. You say, I'm going to enter with these criteria, and then when the criteria are met, you're like a robot. You're like a machine. If this, then that. If this, then that. And you just execute, execute, execute. You do not let your feelings derail you because of fear. Now, the second trade we'll get into is coming next.
It's a perfect low volume node. And I get it long at the 80s, stop loss under the 77s, targeting the 90s, and then the 5600s. And this was a 5-to-1 realized risk of
5-to-1, which is insanely good, right? That means for every $100 he's risking, he's making 500 reward for every 100 you risk. Amazing.
Reward ratio and a $16,000 profit, just simply longing the pullback. Here's the consolidation. I just removed the 71s. Here's that perfect pullback into these 80s where the market consolidated. That was the entry long. And then taking profits into strength where my last exit was above the 5600s high.
Okay, and taking profit at a prior high, which is perfectly logical and perfectly reasonable. Okay, now what I pointed out to you guys earlier was how the market moved down here. Right? Remember that? I was showing you the 2 criteria for a major trend reversal, which is a break of that trend line and a retest of that high in this case, and then we moved down, okay? But what he did is he waited for that move down, and then he's looking for a reversal back up, okay? Because if this is the S&P and we zoom out, the S&P from a big picture perspective on higher time frames is actually in an uptrend, okay? So he's looking for this. He's seeing the market reversed here into this support area, forming a double bottom. Do you see we bounced, boom, boom, making this double bottom? You could connect the line and show that right there. And then it went up, and he's seeing this is a consolidation area. Now the price is coming down here to test where the price broke out of. It broke out of right here because this was a prior high, and then we broke out of here, and then we broke out of here again. So it comes back down into this area to test. That's what the market is doing now. For the bears are like probing to see how strong the bulls are. And then they get 1, 2, 3, 4 candles, all very weak. Do you see how there's tails on the bottom of every single one of those candles? That shows you that the sellers did not have strong conviction, because it shows you that they were not selling into the close of that candle. In fact, they were panicking out and buying back their shorts into the close of that candle. And at the same time, bulls were probably buying when the candle gets down to these lows. Okay. So they tried 1, 2, 3, 4 times, failed. And then the bulls, look at how strong this buy signal is. Very strong bull bar, bull breakout, breaking out above all these maybe 20 candles to the left. This shows very strong buying. So this is like a bitch slap from the bulls saying, bears, you can try us and you can try us. And after you try us 4 times, we're going to block you every time. And then we're going to really show you who's in charge. Now, when this happens, this traps the bears, because there were bears that were, probably had short orders waiting here or maybe somewhere up here, and they're trapped now. So they're going to exit out of their shorts, which is probably what's happening here. And then the bulls take control and we ride this thing up. And so he's going to get long after this, just betting that this strong trend, after having identified evidence-based indicators that this trend is strong, evidence, not hope, not imagination, evidence that the trend is strong, he's going to get long, and then he's going to take profits at a recent high. Very simple strategy, but very effective.
5,600's high a day, and as it broke out above this, I was able to take profits, which was a perfect high a day exit. And this is why it's so important to put targets at levels where the market can reverse. Every single target that I place is where it proves my analysis correct and where the market can possibly reverse. And this was a perfect exit there at the 5601s, because that was the high of day. And this was just such a beautiful trade, capitalizing on the buyers that I saw 2-3 times on this morning dip. Okay, so now March 12th comes. This is Wednesday, and this was a rough start to the day.
Okay, so that was trade 1. You got the details. Let's go to trade 2 and see what happened there and see the strategy and how he applied it to this one.
And a lot of emotional mistakes, a lot of buying just because I thought the market was going to go up. And the first trade that I took was from CPI data. I took a pre-market trade, which I rarely do. And this was a break even. Now, the second trade was a $4,200 loss, and this was a stop out within 1 minute. I essentially got long as the market was dipping down, and immediately this red candle stopped me out for a loss, and this was a $4,200 loss. Similarly, the next trade that I took, $3,500 loss. This was a 2-minute long trade again. I basically longed the market on the way up, and then 2 minutes later it stops me out for a loss. Now, I start the day down a little under $8,000. I'm basically 1 break even, 2 losses, and I had to walk away. Now, I'm just going to go through my commentary in the Discord. Again, like every trade that I take is in here, win or loss. Everybody could see my emotions. Everybody could see things that I'm doing right, things that I'm doing wrong, things that I, shouldn't be doing, and I just try to highlight my trading, the good and the bad. That way everybody could see it. Basically, highlighting my confirmations, the market was selling off. I saw a bunch of absorption, saw even more absorption, didn't work out on me, and then I start the day finding it difficult to short the S&P while Tesla and Nvidia were up 9% and 7%. Now, I walk away, basically did something completely unrelated to the market because I just felt the itch to execute, and I felt the itch to make my money back, and I felt the itch to kind of prove myself correct. The market, like I've been mentioning, the past couple of weeks has been severely downtrending, and the majority of my wins have been off of longs. So I sat here trying to long this sell-off down, which again, I'm not going to say was the wrong decision, but one of my rules is to not be a first buyer. When I notice every single rally to the upside fails, I don't like taking the market long on the first sign of buying. I'd rather get in when the buyers show themselves, and then I could get in on the retest. So that was kind of my mistake that I was frustrated with. And I was also frustrated that I had a bearish plan, which I'll pull up the pre-market plan here. If this yellow line breaks, then I'm going to be looking for it to act as resistance for a downside sell-off into the 55, 53 level that, again, was on the Thursday trade. But I kind of went against it because I wanted the market to bounce and I wanted to see it move up because I saw Nvidia and Tesla up significantly and I didn't want to go against that and short that. But without ranting too much, I walked away. I was frustrated and I felt like trying to catch this move and I wasn't comfortable with it. And I did something completely unrelated to the market. Now, a few minutes later, around 11:20 Eastern time, the market dipped down and again.
So we can see he made some mistakes here and he's being honest with that, which I really appreciate about this guy, right? It's rare that you find people be honest with you in trading, right? I appreciate anyone being honest. So he's saying he made some mistakes. Good. But let's see how he reacted. It's not about making mistakes or not, because even someone like him, I think this guy's been trading 8 or 9 years. You'll see traders who've been doing this for like a decade and they still make mistakes. So if you're making mistakes, you don't need to beat yourself up. You don't need to feel bad about it, okay? What you need to do is look at how you react to those mistakes. So let's see how he reacted to those mistakes. And we're going to see the real mark of someone who's either effective or ineffective at trading. Let's see.
And what I said about not being the first buyer here, similar to the confirmation that I saw on Thursday, we see the same thing occur here on the S&P 500. So on the previous sell-offs, we see the rally here fail. We see the rally here fail. We see even this rally fail. Now down here, this market is trying to rally to the upside.
Okay, so this is a downtrend, right? And what you're seeing here are pullbacks in a downtrend. So if you're getting long on these entries, right, it's probably not going to work out. And if you are getting long, it's low probability that that trade's going to go very far. Why? Because the momentum's pointing downward. And what happens in the markets is that the market has inertia. What does that mean? It means the market tends to do what it's been doing. It's got momentum. It's like taking a ball and rolling it down the street. It doesn't just stop and go the other direction. It moves in the direction it's been moving more often than not until it stops. But it goes that way for a while, right? So that's what's happening here. This is the ball rolling down the hill. So even though you get these small pullbacks, they're like little pauses in the trend. They don't go very far. And so when the market's trending in a direction like that, the highest probability thing that you can do is either trade with the trend or wait. Either trade with the trend or wait. It looks like what he's going to do is wait for those pullbacks to get bigger and stronger and repetitive, and then he's going to consider entering long. Because every time that you get a pullback, that's like the other side, the bulls in this case, smacking the bears and saying, we're coming for you, we're coming for you, we're coming for you. And after enough times, you'll see this on any chart in every time frame, after a certain amount of pullbacks, it gets 1 pullback, 2 pullback, 3 pullbacks, the other side starts to weaken and get exhausted, and that's when the opportunity for reversal starts to arise. So let's watch for that.
Now on this rally, it's met with a higher high as we get a breakout, which is something that we have not seen on a previous rally where the market puts in a higher high. If we were to look at all the previous levels, this is lower, this is lower, this is lower, right? Every high is lower than the previous high. We're putting in lower lows and lower highs. Now we're seeing the rally down here with a strong continuation to the upside and now putting in a higher high. Now, similarly to what I was just mentioning on the Thursday trade with the confirmation, the market essentially does the same exact thing. Here, the market consolidated prior to a rally up and after a rally up, which is that second rectangle that I just put right there. So now we see a period of basing that I am looking to long a pullback in. The market sells off aggressively into this level, also coincided with a low volume node, which again, something that I've recently been taken, and the market rallies up and I find enough comfortable confirmation, which I'm now going to mark this basing period right here as a market structure level of demand. The market pulls back into this level, and after the first failed 3 attempts of a long, I find good enough confirmation to take the market long as it's selling off down here at the 64s, going for a 26-point target and 5 points worth of risk. This trade was a $20,000 profit. I got 26 points. And for me, 26 points is a decent amount to take from the market. I don't really have further out targets, but because of the buying activity, it was about a 5-to-1 risk to reward ratio, $4,000 worth of risk to make this profit. And looking at
risking 4,000 to make 20,000, yeah, I'd take that trade.
The chart, this looks identical to that confirmation, right? Here's the market structure demand, rallies up, pulls back into this perfectly, and I find confirmation to take it long down there.
Okay, so what do you have? You have a breakout, you have a pullback down to that breakout point, because look, this line you drew here is where the price broke out. Did you see how this was the high? here, and then we broke out, and then we came back down to test that area where the price broke out, and then found buyers, continued up.
Targeting the next level of resistance, the market rallies, and I get all out of the position there. And that confirmation looks identical to the confirmation that I missed on Thursday the 13th, that the buyers held that market structure demand perfectly. So it's just about spotting patterns that repeat themselves. It's just about spotting things that, and here's the continuation up. And I was targeting the 90s. So here's my entry. And the reason why I was targeting the 90s was just simply this little swing high right here. So long down here at that market structure demand, targeting that swing high. That was the next level of resistance that I could have came up with. And yeah, in hindsight, if I kept holding, it would have been a massive winner. It was a V-shaped recovery, but my job is just to locate my setups. I know the patterns that I'm looking for. Like, all my setups are repeatable. All these recaps are repeatable because the setups that I'm taking are so repeatable that I'm just looking for them every day. And when I see them and I know that the risk makes sense, that's when I click the buy or sell button. And it's just spotting these patterns, knowing your setups and taking them and having the confidence in them. And as I'm recording this video on Thursday, this is how basically my month is looking. My average win to loss is a little lower just because of a lot of trades going past my stop loss in this volatility, which is something that I can, make a lesson on. But pretty well start to the month. It's
amazing. Okay, and what he didn't say was patience. Okay, that's something that he should have mentioned, because you can't do what he's doing without the patience, and that's what new traders don't have. Excuse me. And that's what new traders don't have. Okay, so the questions to ask were: what confirmed his entry? 2, would this work for a beginner? No, unless you have patience. So either, and no one's born with this kind of patience, okay? Because what you want to do is, when you see a pattern or you see a trade or you see an opportunity, you want to get in there. That's where FOMO comes with, but that's not what you want. So the only way this would work for you is if you're willing to be patient and develop that patience. That's what he does that he did not mention. And that's what I want to mention to you. This is way easier said than done, okay? Being patient is incredibly difficult. So understand that. Now, there are hidden risks in this trade setup, and the risks are that you're going to enter too early, okay? Or you're going to panic out when you get a pullback. So make sure that you're aware of those common pitfalls. Now, what about other common trading mistakes to avoid? 1, chasing the move too early. You could see this is not his problem. In fact, he had the opposite problem, which was not getting in there when the signs were there. But getting in too early is a problem, and getting in too late is a problem, okay? So mistake number 1, chasing the move too early. Don't do that. Wait for confirmation. This is why traders lose by jumping in without confirmation. The solution to the problem is waiting for confirmation. You want a minimum of 2 trade signals before you enter, a minimum of 2, ideally 3. The second one is ignoring confirmation signals. Now, he did that, right? So how do you properly confirm a trade before entering? You got to write it down. Notice he's writing on the chart. He's drawing his lines. He's typing out what signals are going to validate his idea or invalidate his idea. Mistake number 3, emotional trading and overconfidence. Now, the psychology behind his trading day was that he was able to be patient, which we've established. And the other thing I pointed out to you is that he doesn't suffer from FOMO. If he misses a trade, he's like, oh, even more opportunity. That's how you want to be thinking. How can emotions destroy your trading account? Is you get in your head, you beat yourself up, you give yourself a hard time, and you think you missed out. Listen, the markets are an infinite, endless parade of opportunity. Always remember that. The markets are an infinite, endless parade of opportunity. And if you miss a trade, there's always a later, better trade, either today or tomorrow. The final verdict: should you use this strategy? These are the questions that you need to ask. If you're a beginner, would this work for you? That's for you to say. The key adjustment to make it safer is to size down. Trading this kind of size for a beginner would not work, but you could trade pullbacks like this. I trade pullbacks with different indicators, but trading pullbacks is something that every trader could do, and one of the best strategies for beginners, but you're going to have to size down. Now, the final takeaway for consistent trading success is what? Patience and discipline. Patience and discipline. Those are the 2 things that will sabotage any strategy. And those are the things that you cannot learn from someone. You have to learn on your own. You have to practice, and you can only get By practice. That's it. You practice on a trading simulator first, and then you practice in the live market with small size, then you slowly size up. That's the only way to do it. Now, here's your Trades by Brent Take Action Challenge. I've got 3 things for you to do to apply. The first one is to identify one pattern that repeats in your favorite market and write it down. I like pullbacks. What about you? Step 2, backtest that pattern over the past 30 days and record when it works and when it fails. Step 3, before your next trade, ask yourself, do I have 2 confirmations before entering? And if not, don't enter. That's your Trades by Brent Take Action Challenge. And if you take the challenge, I can promise you, you will see a transformation in your trading results. Now, if you like this video, then I think you'll like my private community. Patreon.com/Trades by Brent. I will also link it up in the description and invite you to join us. I do premium content and premium trading videos there to help you learn even more. If you want to go even deeper with me, check that out. Also, if you like the video, hit that like button and subscribe if you want more from me. I'll see you in the next one.